All right, everybody, welcome to the Sherman Show. I'm Jeff Sherman here with my co-host, Sam Lau.
Hey, hey.
And today we have another exciting guest, as we keep doing here on the Sherman Show. We have none other than David Costen from Goldman Sachs. Welcome to the show, David.
Thanks for inviting me. Nice to be here.
Absolutely. And for those who don't know David, I'm sure everybody does, but he's Goldman's chief U.S. equity strategist and responsible for a small task at Goldman, just analyzing and forecasting the U.S. stock market. So a very small responsibility you have there, David.
Well, it's interesting. It's active. Never a dull moment. And that's the forecast here.
That's the forecast. So with that, tell us what you're seeing. You know, we've seen the evolution of the equity market. We saw, one of the fastest drawdowns in history in 2020, one of the fastest recoveries as well. A lot of people, missed some of that rally, thinking that there's going to be rollovers and the like. You guys were very good about calling this. You guys have nailed your economic forecast as well, pretty strongly this year. So, what are you seeing as we go into the fourth quarter in the U.S. equity market? Obviously, there's been some stumbling in September, but how are you thinking about the setup of the market? What are you seeing there in the U.S. market today?
Well, I have the benefit here working amongst a group of macro participants in the research department. My colleague Jan Hatzius is our chief economist, and my responsibility is focusing on the equity market. And so taking that as a launching pad, we basically have a decelerating economic activity here in the US. So that is a cautionary aspect. On the other hand, from a corporate profitability point of view, businesses have responded quite effectively in this, not just the early part of coming out of the pandemic, but more recently, becoming more efficient. And we've, surprisingly, frankly, come back to record margins. We have record profit margins. When I say we, the S&P 500, if you look at the Russell 2000, some other various metrics for the U.S. Equity markets and different benchmarks, but profit margins have come back dramatically. And so I think that's really the key story, as far as I'm concerned, is looking into the fourth quarter. The economy will be decelerating, or at least that's our forecast. Rates are likely to come a little bit higher than where we are now. We're kind of 1.3% or so the day we're recording this podcast, and maybe rising to around 1.6% on 10-year Treasury yields. And that's generally reasonable backdrop for equity prices rising. And so a forecast, Jeffrey, at the end of the year, around 4,700, which would be up maybe a little over maybe 6%, 7%, depending on where we mark the end of the day today. That's the trajectory, and as I see it.
Yeah, 6-7%. That sounds like, just roughly 4.5 to 6 years in the 10-year, right, of yield that you would get there today. So not bad for a quarter's return. One thing you mentioned was profit margins and peaking. And I've heard this narrative from many pundits and analysts out there, peak growth. And you referenced deceleration. I've heard this both in the economic growth as well as the earnings side of the equation. And I like to remind folks that peak growth doesn't mean that, we're going into a recession, right? It's just the rate of growth is decelerating. So how are you thinking about that? And what do you think about kind of as we get into 2022 and the trends you see underway in the setup of corporate America?
So the idea, and it's a good point to clarify, the idea of decelerating growth, again, is growing, but just at a reduced pace versus the previous quarter or the previous year. And so the setup looking into 2022, and make no mistake about it, Jeff, right now, everyone, when I say everyone, the portfolio managers with whom I speak, which is sovereign wealth funds and pension funds and endowments and insurance companies and long-only mutual fund managers, large cap and small cap and hedge funds, the entire investment community and the risk asset of reference in the world, let's be pretty clear, is the U.S. equity market. It's not treasuries. It's the equity market right now. And the focus is on next year and what the trajectory looks like. And the idea of economic growth persisting and continuing, but at a decelerating rate, means that companies in the corporate world that have a better probability of having more secular growth, if you will, can paddle in a direction which is less affected by the vicissitudes of what's happening in the economic environment. So what are we talking about? It's duration. it's equity duration. It's the same concept in the bond market. The idea of when is the average time in the future you're generating these cash flows. And the idea for companies, that's what the market is traded all year long. It's not so much cyclicals versus defensives or value versus growth, it's duration. And the idea when rates were rising, companies that had a shorter time life for their cash flows did really well. And then really since March, it's all been about, as rates came back lower, it's been extending duration, just like you did in the bond market, I'm sure, in your portfolio. And so these secular growth stocks, arguably those that have, if you will, in cybersecurity, some of the software companies, that's what everyone in corporate America is doing. They're spending money on technology to maintain and try to improve their margins. And those are the beneficiaries, whether the economy is growing at a more rapid pace or a slower pace. What we've seen is this persistence of growth. So I think that going into 2022, the idea of rates going a little bit higher, generally speaking, it shorten your duration, but we're not anticipating that rates go that much higher. And so some of the bigger cap, more secularly growing companies would be benefiting, in my view, in this backdrop that I just sketched out for you.
Yeah, it's amazing you use that comparison to duration. And I did an external podcast, not my own, yesterday. And we were talking about this, and I was saying, about rising rates and how it affected things. And I used the concept of duration as well, like you did. And, they kind of scratched their heads. And I said, look, what's the meaning of duration? We all know the mathematical, it's for a rise in rates. But when you learn the concept of duration, it's essentially what's your break even on the present value of the cash flows, right? That's what you're talking about. How long does it take you to, on average, on a PV basis, to get your money back? It's exactly what you're talking about in the multiples here. So what are some of the risks to that argument as well right now, as we think about margins coming under pressure? We've seen kind of the rise of labor and having more pressure on the wage component. How are you factoring in that to your analyses as you think about 2022?
So here's how we think about, when I think about duration, we think about what percentage of the valuation of a stock is attributable to the cash flows in the next 10 years, and how much is the perpetuity. So the super fast growing companies, a larger percentage of the value of the shares is really that longer term growth. So how do I think about that? So when I said earlier that margins are at peak levels, net margins in the tech sector are 25%.
Wow.
Net margins across the rest of the US equity market, 12. 25 versus 12. So first of all, there's a lot more money to play with, if you will, margin, pun intended, a lot more margin to play with in addressing the higher input costs that may also be there. That's number one. Number two, as we think about labor costs, like where are some of the big input costs that everyone's focusing on? Labor is one. And sort of the idea is really what's the impact on margins, but labor costs will be one. So the typical company spends around 13% of its revenues are consumed by its labor budget. I use that term labor budget. That's your salary, bonus, medical costs, stock-based compensation, options, the whole shooting match. The cost of your employee base of a company, it's around 13% is consumed by labor, and that's going to range from 5% at the low end to 25 or 30% at the high end. So what we're looking for is, not looking for, but what is likely to do better, have less sensitivity to margin pressures, are companies where there's high margins to begin with, and then where their labor costs are, generally speaking, somewhat less on the lower end of that distribution. And you see that often inside the technology companies. On the other hand, if you're looking at more consumer facing, some of the industrial companies, they have a higher proportion of their revenues are consumed by their labor budget. And so that's one big variable. I'd say labor costs. The next big issue out there is taxes. Right, we're sitting here today. I guess it's the 21st of September. There's expectation of a tax agreement. There's infrastructure, and then there's this sort of reconciliation. And the assumptions that I am making, along with my colleagues in economics research here at Goldman, we're assuming that there's going to be a tax hike that's going to take place on the corporate side. Exactly the specifics of that still being negotiated, but we're assuming that, Jeff, in our earnings forecast, which is only 2% earnings growth, 2% from this year, 2021, until 2022. So that is part of a headwind. If you told me we're not going to have a tax reform or tax hikes, then we'd have earnings growth around 7%. So you kind of, in our view, we're kind of walking that down to around 2% growth. Coming full circle back to your earlier question, why is it that that secular growth, why is it that longer duration stocks are likely to do better, is because they have generally higher margins, significantly higher, and they are less exposed on the labor front. And number three, they may be subject, like everybody else, to some of the taxes, and it depends on where the specifics are, how much of the increase in taxes is for non-US revenues versus domestic revenues, a lot of the specifics. But I think that's the backdrop as I see it, and why those stocks likely to do better.
Yeah, I think it's a great environment to have a low overhead and low labor input costs at this point, just given what we've seen, just the pressure on wages generally. But as I think about the other thing I'm asked a lot about is really the inflation front. And so walk me through how you guys are viewing inflation today. And does it matter, given that you said really it's a duration trade? So if the bond market effectively kind of ignores the inflation prints that we've seen, obviously a big Fed meeting tomorrow, where our listeners won't get this till after that on Thursday. So I won't make you make a forecast on the Fed. That's not your business. But as you think about the inflation component too, how do you think about that working into some of these valuations? Is it just really, does the bond market price it because of the duration component? And if we sit here at like a 130 to like a 150 10-year, it doesn't matter how much inflation we get? Or is that put pressure on margins as well?
So the idea of inflation obviously is your area of expertise as well in your side of the country, I guess, since I'm in New York and you're in California. In terms of economics, is it input costs? Well, you're out there in the heart of the problem, if you will, which is the Port of Los Angeles and Long Beach, which is all the data that we suggest, all the, not just anecdotal, all the conversations I have with corporate executives and public companies, which is there's a huge delay, all the cargo ships out there in the Pacific kind of idling, and then once they do unload the cargo containers, then there's a long backlog getting it onto the trains and have the modal transportation around the country. So that supply chain disruption is definitely something I hear a lot about, and that's obviously one source of inflation. It's clearly visible. You can you hear about it in conference call transcripts and listening to managements in one-on-one conversations. That's definitely an issue. The labor costs we made reference to earlier is definitely an issue. That's another source of if you will, not just inflation, but I'm also thinking about it, Jeff, in terms of how does that impinge on equity prices? It's basically, it absorbs some of the profits that might otherwise go to shareholders, or in fact to compensation for employees. And so when I think about valuation, I'm like, well, it's probably going to come through, as an equity investor, through nominal rates or real rates. I mean, we can look at it, either one of those two directions as a transmission mechanism. And the idea of rates, and well, in this case, interest rates, you said positive scenario 130 to 150. Goldman view is nominal rates climbed to 1.6% by the end of the year, kind of in that range. Basically, equity prices likely to stay at a pretty elevated level valuation-wise, kind of where we are now, and sort of the trajectory of earnings takes us higher. I think the source of demand is where I think about it from if you will, from an inflation point of view. Where's the demand coming from for shares? And it's sort of a supply-demand story. And it's basically individuals. There's more than $5 trillion in US money market mutual funds, and 56% of all those assets are held by individuals. And that money, in my forecast, likely to come into equities. We have the view of the Fed being on hold for 2 years till the second half of 2023. So you're not getting any money on that. Literally, the money market mutual funds giving you virtually nothing. And so some of that money, not all of it, some is going to come into the equity market, number one. And then another big source of it is the corporate bid on the buybacks, which is very, very significant. Now, right now, we're in a buyback. We just entered the buyback blackout period when companies ahead of their earnings are not buying right now. But they have been a consistent source of demand for a decade, one of the biggest sources of demand, in fact, and that's likely to persist. The authorizations this year, Jeff, have been really record high levels. And so demand from corporates, demand from individuals, that's where I anticipate the demand coming from for equity prices. Now I think about it.
Yeah, what about the supply side of equities too? We've seen some IPOs come out this year and we've seen some falter. There's been some good stories. I think of like a Robinhood that performed quite well. And I juxtapose that against like a Coinbase that really struggled out of the gate too. And so what do you think about the dynamic of companies staying private longer, the VCs controlling more of that market, extracting more value to their shareholders and their fund holders prior to bringing them to market versus kind of those traditional paths we saw 20 years ago. And so do you think some dynamic has changed there, which also brings this competition in for the existing equities? Or do you see that kind of changing with, we have a couple IPOs coming out in the next week or two, right?
The volume of equity issuance has been extraordinary in terms of not just the IPO market's been super active, follow-on equity offerings, record high levels. We haven't really mentioned SPACs, the special purpose acquisition corporations, which are basically a sort of a blind pool of capital it's raised to then go and acquire private companies, if you will, a reverse IPO, if you think about it in that context.
Yeah.
And so that was extraordinarily active from August of 2020 last year till around the end of March of this year. So that was about 6-month period when it was extraordinarily waved. There were on average about sort of four SPACs a day seem to be going public for pretty much a 6-month period, and that's certainly slowed down a lot. But your question is an interesting one, hugely debated, by the way, on the idea of companies, if you will, should they be delaying? Should they be? But they have been delaying going public for a long time. Multiple rounds, A, B, C, D, E, F rounds in the private equity world, raising capital in the VC world, and then going public much later in the life cycle, as opposed to historically companies went public earlier in their life cycle. Well, the issue is historically, we've done a lot of analysis. You're basically looking for about 40% revenue growth. 40% revenue growth that's forecast over the next couple of years, A, and B, a path to profitability where companies are positive net income by year 2 or year 3. Those are statistically significant predictors of whether a IPO, a new company, actually outperforms the benchmark. Revenue growth, 40% a year for the next several years, A, and path to profitability. Those two variables are the key. And that's what the analyst community and investors are trying to identify those companies, because there's a tail. And the few companies that really outperform do great, generally speaking, statistically. Yep. And then a whole bunch of IPOs tend to lag. And that's why people are so focused in this area, where they often come in at a discount valuation.
Yeah, well, you also mentioned SPACs too. And so, these have been some of the darlings of the industry, been able to raise, blind pools, as you said. And then as of late, they've struggled a bit as a cohort, right? And so when you think about kind of the SPAC business, and you call it the reverse IPO, I'll call it OPI just to, reverse it there, the acronym. But, when you think about what's going on in that market, is that really just a better way of executing a business plan where the person with that capital is able to bring that to market, and you're just using this blind pool to go after it? Or how do you explain kind of the phenomenon there in the SPAC world?
So there's a lot of nuances relating to the special purpose acquisition corporations, that the SPACs, why they sort of they've been around for decades, right? Why is it that they had a flurry of activity? Well, part of it, I think, was coming out of the COVID, the crisis, there was an opportunity set. A lot of companies, small private businesses, needing capital, needing access to capital for solvency and liquidity reasons. And so private individuals and these SPACs sort of sprung up as a way of injecting that into companies. And the process by which they do that, of course, is to merge with a private company and a public shell, and that was one of the impetuses, if I would identify it. And then the second is basically raising capital where there's an option on the part of the investor in a SPAC. If you are an investor and own shares in a SPAC, the SPAC manager runs around, if you will, proverbially, and finds a private business they want to buy, merge with, and then they go back to you as the investor saying, "Look, you have a put option. Do you want to continue to continue with this investment, or if you don't, you'll get your cash back with a little bit of interest, and interest rates are virtually nothing, so very little amount of interest, and you know, take your money and go home, if you will. And so I think that was an allure of people saying, look, interest rates are zero. So my opportunity cost, if I had, as long as I didn't need that capital immediately, I had a put option in there. I think people found that to be very interesting. And the third idea, or a third aspect that I would identify, Jeff, is that basically when you go and look at an IPO of a potential company that's going to do initial public offering, all of the financials are backward looking, and you have to make your own projections and assess where you think the prospects are for that business, how much are you willing to pay, almost going back to that, our first discussion point on duration, like, well, what is the forward path of this business? Whereas in the world of a SPAC, when it was merging with a private company, those documents would become filed with the Securities and Exchange Commission. They could include, and often did, here's what the model of the private company, which was private, so it could publish these expectations, these forecasts, their budgets for the next
their model, their growth model that always seemed to be upward and to the right. Yes.
Right. Well, and so then you as an investor could assess, you could put your own handicap, put your own haircut on what you thought the prospects of that happening. So I think those, some of the building blocks as to why that sort of sparked a huge activity in the SPAC world. I think it's the rate. I think the low rate environment was a component to it. The opportunity set coming out of the pandemic, the nature of the disclosure and the forecast that could be there, and finally, I would add on these pipes, these private investment in public equities, these yep. other capital raises that would take place concurrently with the closure of the deal. So that's another way of injecting large amount of, it's a recapitalization basically of a private business, taking it public in a big way. And so I think that's certainly something that has been a big area of focus. I think it's less active right now, but meanwhile, all that capital that has been raised, those are deals that are likely to be announced sometime in the next year, because they sort of had 2-year horizon to make an acquisition. So that's a big area, I think, of deal flow happening going in the future. Maybe less so in the new IPO market right now. I think there's plenty of activity and volume of existing companies going public.
Yeah, no, exactly. One more question on microstructure. I'll let Sam chime in here. I'm hogging the conversation, but I'd be remiss not to ask you about the resurgence of retail trading. And we saw this with number of accounts opened. Robinhood was initially out there as one publicly disseminating their data with their open source data, showing that to everyone. Then they decided to claw that back. They got a lot of kudos for it. But then when you dug into the traditional brokerage houses, you saw the same thing. Number of accounts open, flurry of activity. As you think about that impact on the overall market, we always talk about democratization and we want to bring investing to the masses. And there's a lot of criticism about all these new accounts, these retail traders, they're on Reddit, they're using memes to do investing. How are you interpreting, the impact from retail? And what's your opinion on it? Is it a positive, a negative attribute, or is it just kind of a wash?
Well, I would say it probably come down and it's more of a wash. I would say, on a sort of personal philosophical level, the gamification of investing, I think is sort of a disappointing development. And the idea of investing, not so much professional, but there's obviously real world consequences that people lose money, and that should be appropriate.
And when you say gamification, you're talking about you get the little fireworks when you do a trade or something that releases, the cortisol, or increases your cortisone levels, and
the dopamine. It's like having chocolate. You have your confetti show up on your iPhone, and that you made a trade, and that is a part of the gamification that I'm referencing. That it makes it like a video game. That my teenagers might use, but I think that's sort of a disappointing, because I think, as I said, investing's a serious business, like you would agree, is professionally, but just the idea that there's risk involved, and I don't think that sort of gets maybe reduced.
Yeah, our dopamine doesn't get triggered when we talk about risk management, right? So, yeah.
Right, that's fair point. So when I look at that, we look at some of the ownership categories of the equity market. Household ownership of equities is about 1/3, right? We look at the Federal Reserve data, about a third of the equity market is owned by individuals. And then you could think about mutual funds, both active and passive, own a little less than a third, sort of almost 30%. You look at the pension funds and international investors. You kind of look at those different categories, and that's almost 90% of the ownership of the market comes in those different categories. You can throw on hedge funds and other categories, but they tend to be relatively small in terms of their total dollars, although with the hedge funds, it tends to be a higher amount of the overall turnover in the volume. But your question was about retail trading, and I think about, it's certainly a new source of demand. I'm not sure that's necessarily a net increase, because it may be money that alternatively might have gone into a mutual fund. Instead, if you will, it's been clawed back, and individuals are taking democratization, if you will, Jeff, in terms of taking responsibility and actually choosing to own it directly. I think what's one of the interesting aspects of this is the nature of the market structure. And when you think about the 5 largest stocks in the market, and we can think about Apple and Microsoft and Amazon and Google and Facebook, those 5 stocks, they comprise 22% of the S&P 500. And you can put that as a holding point and say in 2000, 20 years ago, the top 5 stocks at that time were 18%. So we have a more concentrated market today in the overall market. But then, Jeff, when you look at the growth index, say the Russell 1000 growth index, those same 5 stocks are 38% of the benchmark. And now you have a situation where growth mutual funds, many growth mutual funds, are in violation of the SEC guidelines on what constitutes a diversified equity fund. And so you have issues about growth funds choosing to relinquish that designation as a diversified fund, or else they have to diminish or lower or be underweight meaningfully those those stocks, simply for diversification rules. So there's interesting aspects of risk in the passive market that are not always appreciated by investors, because these 5 stocks, and that's not a criticism of the companies, they're just very, very big, they're super successful, they have huge margins, their revenues are growing, and they have had this increased weighting in the benchmarks that's very, very significant, and money that's going into equities, which is very significant this year, is going in proportionally very significantly to those stocks.
Yeah, you mentioned that. I told Sam he's going to jump in, but I've changed my mind here. Because there's an important topic there you mentioned too, because you were talking about indexing. And so we've seen the rise of indexing. Indexing does very well in a momentum-based market driven by the largest shares. And we've seen that for many years now too. And the top 5, on market capitalization haven't changed significantly. They've shuffled around like the top 8 or so. And so there's been this rise of indexing. The ETF has been a great vehicle to execute that idea. Well, what is your take on the rise of indexing? Have we kind of seen the peak in it? Do you expect that to be more trend? The reason I asked that is I just asked you about retail, and you talked about, well, they would have bought a mutual fund or an ETF before. They decide, I want to, control my destiny. I want to focus on 1 or 2 companies. And so what are you seeing there in the data? What's it telling you? What's your gut tell you about the role of indexing as it plays into most investors' mindset?
So when we look at the money flow, we look at this weekly, and obviously in your DoubleLine, you certainly have lots of line of sight into your own business and the flows that are happening there. We don't see that on an individual fund basis, but in aggregate, money continues to go into passive assets. That's number one, and that's domestically. We're sort of coming out of, although at a relatively lower pace this year than in prior years, money coming out of active, but it's still steadily going into the passive here in the U.S. But in non-U.S. assets, it's been equally so, and it's been total inflows, like $400 billion this year, pretty much each side of that, which has been very significant. Non-U.S. equity markets, which are generally trading at lower valuations. We can debate or discuss whether or not theirs are appropriately, given they have less growth and lower margins and less efficient markets, a lot of other things that are taking place out there. But broadly speaking, money is definitely going into non-U.S. products. Now, my focus professionally is more on the U.S. equity market, but my colleagues basically do what I do in Europe and in Tokyo and in Hong Kong, looking at the other various markets around the world. And those trade at lower valuations, but arguably less growth and arguably risk-adjusted returns still, I think, certainly competitive here in the U.S. with some of these other markets. And obviously, you saw what happens in more recently in China on their market. So risk-adjusted, the U.S. still looks pretty attractive.
Yeah, David, one of the things that you had mentioned earlier on was you mentioned put option, and this made me immediately think of the Fed. And I think you might have alluded to the TINA trade as well. And I think much of the tailwinds in U.S. equities has really come courtesy of monetary policy a la the Fed over the last decade. So as we enter Fed week, or as we're in Fed week here, the Fed's policy might be changing over in the coming months. So just wanted to see what your thoughts about the potential impact of a Fed taper of asset purchases on equity performance, and then also once we get there, the eventual liftoff on rates.
So, Sam, it's a good question. A lot of topics, questions that come from clients about the relationship between rates and equities and valuation, and what kind of stocks likely to do well. So first response, I'd say somewhat trade expression, but tapering is not tightening. I would sort of embrace that view. Okay, so they're reducing the pace, and I have the benefit.
It's like deceleration, right? We talked about it too. It's not peak; it's just decelerating the purchases.
Right? So I have the benefit of my colleague Jan Hatzius and the team down the hall were telling me kind of here's their forecast for the deceleration and the tapering, if you will, of the buying in the long end of the curve. And so that seems a reasonable assumption for us to be making. The Fed seems to be telegraphing that, quite directly, if you will. And the assumption from the Goldman economics team is that the Fed will not be having liftoff, to use your term, Sam, or actually hiking on the funds rate until the second half of 2023. So that's 2 years from now. So in that environment, yes, to get some tapering, maybe we can debate or discuss what the actual pace that will be in the tapering, but should be completed sometime in a year or so, and then it will take some additional time interregnum until they actually start to tighten. So that's sort of the assumption that we're making here at Goldman, and that's where we look at, well, in the equity market, it'll have an effect on valuation, but you referenced the TINA trade. There's no alternative. I believe what's one of the reasons why equities continue to receive inflows, because credit spreads are unusually tight. Our view is they'll probably widen on the high yield and on the investment grade side. The actual rates themselves, maybe they go a little bit higher in terms of Fed Treasury yields going a little bit higher. But it's not as though these other alternatives are that attractive in the equity market. You can look, commodities have already had a huge run, although we're pretty optimistic in terms of Goldman Sachs and my colleagues focusing on the commodities area, aluminum prices, copper, et cetera, likely to go generally higher. So those are the other some of the obvious alternatives we think about. Equities look pretty attractive in that world. One of the things, going back to that earlier point we mentioned, why, Sam, would the rates be going higher? We're kind of further along in the economic expansion, but ultimately it's about inflation, and ultimately from an equity investor perspective, it's about margins. It is about margins and what companies can do, which companies are better or less well-positioned to pass through those higher input costs or manage around it. And one of the things we clearly picked up on in not just the first, but even the second quarter conference calls, and of course we're coming up on when we'll have the third quarter conference calls, managements kind of go through all the different levers they're trying to pull and positioning to try and maintain, or if anything, grow their margins. And I have certainly been surprised, but margins across the market are at record high levels. And what we're looking at in this context, Sam, is, well, which companies have high and stable gross margins? Who's demonstrated the ability to maintain their margins over the last 4 or 5 years, even going back before the pandemic? Sort of who's been able to generate those stable margins? And that's valuable. That is worth something now in this environment.
Okay, I appreciate the comments from your team too. We spoke with Jeff Curry last year, and we wholeheartedly agree with him. We like to debate things. That's why we love having Goldman come in. We like to have those intellectual debates, but it was hard to disagree with anything he was saying there. And so Well, one thing that we've heard a lot about too from investors, and we've seen this in the consultant community and institutional community, is the rise of ESG and, the investing. And, and again, I was talking to Jeff about that, when he was, in our virtual office and we were talking commodities, and how perverse it is that, we have to use more carbon, we have to use more pollutants to get to this level. And everybody focuses on the E component of that. What are you seeing from both client demand and how you guys are thinking about ESG? Is it, is the label and the moniker just a fad for, people trying to raise money? Obviously we all care about the E, we all care about the S, and we've all as investors done the G. So, isn't it entrenched in there? Is there something different this time? How are you thinking about the whole ESG movement?
So it is a widely debated topic in the investment community. And we know the SEC is looking into some mutual funds that have been marketing their products, indicating that they're using ESG. And the question is in what form, and are they really doing it in terms of in their security selection? So it's definitely real. There's no question. Engine number one, which obviously won the proxy battle against Exxon in most recent proxy season. So there's definitely investor interest embracing the topic of ESG. My observation would be a couple. Number one, E, S, and G are interesting three letters of the alphabet, but they're not really related to one another. I mean, there's environmental, there's the governance, and there's the social aspect. And it's a little bit like, I guess, motherhood and apple pie, although I should maybe put parenthood and apple pie to be more inclusive. But the idea is nobody's against any of those. Yes, we should be more carbon friendly, carbon neutral, environment, global warming, et cetera, et cetera.
Be better to one another socially, and run things well, right? Yeah.
And have good governance. So all those things seem like they're reasonable. The idea of a common standard, I think, is a real problem. And I say that if you're looking, and now your personal expertise or background is more, say, on the fixed income side, at least my understanding. And so the idea of, if you look at Duff & Phelps and Moody's and Fitch and Standard & Poor's, there's like a 0.99 correlation, meaning all of those debt ratings, I'm talking about debt ratings, are pretty much consistent. They all use the same algorithms, they use the same balance sheet analysis, all those metrics. So that's what they do. Then you look at the different ESG providers, and there's a bunch of data providers, and they have like a 0.3 correlation because they're looking at totally different things. And as both a management team of a company as well as an investor, well, which of those metrics should one be looking at? And I think that's one of the concerns I have as an analyst, as a strategist, which is, all right, I totally embrace the ESG concept, but what is that telling us about what's the right way to look at the data? How should that be disclosed by companies? And frankly, our analysis suggests that the market is not paying for a high or a low ESG score. And I think ultimately that's the bottom line as a fiduciary obligation of an investor, which is, all right, are you investing the money? And if the market isn't valuing that as an attribute, it may be socially good to be doing this, but market isn't paying for that right now. It may at some point, but thus far we haven't seen it.
It's amazing you point that out, because I think it was the SEC that came out and said that you cannot put, like, in a retirement, a qualified account, an ESG fund just because it's ESG, right? Your fiduciary duty is for the investment returns and the attributes of that product. And ESG did not qualify. And a lot of people scratched their heads when that first came out. But I think you point this out, and it's a very good observation too, because a lot of the academic journals articles that I read about it, because I'm very interested to try to understand this, as we look back, you think of Sharia law and, the sin stocks, how, if you invest on behalf of a church, it'll say in your IMA, you cannot buy these certain stocks. And you go back and look, and it's like, those are some of the best performers because they've been overlooked by the market. And then others question the efficiency of capital. So I think it's a good debate. I mean, I think you said it well, because none of us really argue that we want less carbon, we want to be good to one another, we want well-run companies, but is it the end all be all? And that's kind of the question out there too. So I think it's a bit more philosophical than necessarily black and white today.
But we are seeing, Jeff, just to be very clear, there's huge inflows into funds who designate themselves as ESG compliant or market themselves in that fashion. And so when we look at the flows, just like we're looking at flows into US and non-US and growth and income and value funds and all the different, if you will, layers of where money is going, ESG funds has been garnering a positive flow, both passive and active, consistently for 2 years. Very significant. And so it's definitely where the money goes, then the companies have to respond to that, or they often will respond to that. Sort of Pavlovian, right? Behaviorally, that's where the money is. You want to be making sure you're checking the box. And so there's a little bit of a greenwashing probably that goes on. Exactly. Sure. On Earth Day, mark it in your calendar. Earth Day is going to come out, and that's when all the ESG statements of the companies that they publish on recyclable paper that they then send out about how they're doing all these wonderful things. That's a cynic in me as a strategist. But that, again, it's a laudable goal. We all agree with those three things. I think defining it is a challenge.
Yeah, no, I think you realize that us fixed income folk, or at least trained in fixed income, we tend to be cynics as well. And look, it's a hard attribute to figure out, right? Because that Venn diagram, it's hard to find things that line up in the overlapping of all three circles. So I have one last question for you, David, before you go here. And let's be timely to our investors out there. How should people think about their allocation to U.S. equities today? I won't put you on the spot on the bond market, but should you be overweight, neutral? What parts of the market are you liking? Give some advice on what you're telling your clients, to our listeners today.
Okay, so the idea of the outlook for U.S. equities is pretty optimistic, and that is the idea the economy is decelerating. We've talked a little bit about that. Earnings are growing. Valuation is high in an absolute context, but it's more reasonable in a low interest rate environment. And the money flow is coming into the market. So you keep that as a framework: the economy, earnings, valuation, and money flow as a framework. And in that environment, what is likely to do better? So try to sketch out in our conversation today: technology stocks, generally speaking, they're less sensitive to some of the margin pressures. They're starting with very high margins. There's less pressure from a labor cost point of view, and their ability to be more secularly growing. Arguably, I use an example of of cybersecurity. That's just becoming, I would argue, it's just going to become more and more and more and more important as you go through. Whether the economy is growing rapidly or slowly, it's likely to benefit. And there's a lot of
we saw the iPhone hack, right? Where I can just send you a text message. You don't have to open it. I can control your phone. Not that I would do such a thing, but
not that you would do such a thing. But anyway, that's the argument number one. Number two, the consumer reasonably optimistic in some pockets of consumer spending that are there. I would say areas to be areas to emphasize, areas to be more cautious about. Real estate right now would be one area. Utilities, some of the more interest rate sensitive equities components. Some of the consumer staples companies, they've been very successful in passing through their higher input costs, taking up basically prices around 5%, most of them across the board in the summertime, raising prices on their products. So their margins have been good and they've been stable, but they're not necessarily as high as some of the other companies in some of the other industries. So I'd say those are some areas: real estate, utilities, consumer staples, sort of less enthusiastic about those, more focused, say, in the areas of technology. And I think that's a way to focus on it. When I come back, ultimately, I think it's about duration and where do we want to be in that, and would rather be a little bit longer duration as a strategic investor looking out.
Yeah. Okay, got you. So that is very helpful. It's a great conversation, David. I really appreciate the time you spent with us today. I love the speed and the energy you bring. There's a lot of that I share that similarity. Some people say that, I'm always just yelling at them and going at them too fast, but I love it. I like that people can slow this down, rewind it, and listen to you again. However, but before you leave, we got to introduce you to Sam's favorite part of the show. So Sam?
So David, that part of the show is called Sherman Says. It's where I'm going to offer a series of alternating prompts between you and Jeff, to which I hope to get a concise, short, maybe even one-word response to that is top of mind. It's been referred to as a verbal Rorschach before. So I'm going to start out with Jeff to give the example with equity bear market.
What bear market?
Over to
Unlikely.
you, David, a new one, share buybacks,
Powerful.
corporate tax rate.
Going up.
Higher.
Yeah. Oh, we alternate, David. You can't get them all, you know,
Yeah, this was to
Okay.
Jeff.
Yeah.
Corporate tax rates.
higher.
Back to you, David, with meme investing.
Overhyped.
$1 trillion coin.
I'll take one. Jay, I'll send you my address tomorrow at the Fed meeting. Let me know.
Not sure if that'll cure the debt ceiling problem or our debt load, but you'll take it.
I mean, I'll just put it on the wall. I'm not going to spend it. It won't be inflationary. I'm going to be the one with the $1 trillion coin.
All
It's
right.
not like someone's going to steal it. What are you going to do? You can't go spend it. They're going to know you stole it.
Yeah. Well, at this point, you might not be the only one with a $1 trillion coin either. So we're passing them out.
Yeah, it's
Well,
like the
back to you.
100 trillion Zimbabwe note, right? So
Back to you, David, with contagion.
Won't happen.
Deficit spending taper.
won't happen. I like to recycle for the next question at times. We'll
They
see.
tend to work too. It tends to work.
Yeah.
So back to you, David, with leverage.
Corporate leverage is high, and retail leverage or personal leverage is low in the data.
That's actually a very good point, because most people don't realize that the household balance sheets have improved massively by both asset price and paying down debt. So where corporate America took it on and the government did, at least the consumer did not follow. So that is a sign of health in the long term.
Yeah, maybe that's the next chapter.
Yep.
So we're moving to the final round here. Sherman says, for Sherman, #1 irritant post lockdown.
Wow.
I'll
So I
answer.
can't have it pre? It's only post.
Traffic.
Yeah.
Never mind, I think.
Yeah,
Commute.
that's always been one. I'm trying to think of something new.
But see, that's because you're in California, Los Angeles traffic. But in New York, in the COVID, there was no traffic for about a year. Now it's back to normal. There's a lot of traffic.
Post lockdown. Okay, so coming back, I'm irritated by wearing the mask for prolonged periods of time. I was a total masker. I was okay with it. There's something about the facial hair. It just doesn't work well. So that's the thing I'm struggling with the most when I have to do it for long periods of time. So like a 5-hour flight to New York, for instance, that's pushing the limits.
Yeah, that's what got me.
Yeah.
All right, and then the last one for today to you, David, is the #1 on your post-lockdown bucket list.
International travel.
Where
Absolutely.
to?
For both business and personal. It's been too long since I've had to use my passport.
Yeah, the thing about international travel, it's a time where you get some good thinking done too. You're not going to be bothered. It's just a great place. So, David, we want to thank you once again. Thank you to all our listeners for providing us feedback. You can hit us up at use the email address shermanshow@doubleline.com. We'll answer all your questions. We'll take some recommendations too of guests out there. But also, most importantly, you can catch us on YouTube. We're back to video recording here. We got David Costen live from the Goldman offices in downtown New York. And so we appreciate all of our listeners. You can hear it on SoundCloud, Stitcher, Spotify, the Google Play. And don't forget to follow us on the Twitter, right? The Twitter is where we're at Sherman Show Pod. So thanks again, David. We really appreciate it. Thanks for bringing the energy to the Sherman Show. Have a great day.
You too. Have a nice day. Thank you for having me.
Okay, take care. All right, thanks again. Bye-bye now.